Welcome to Module 6, Smart Contracts and Distributed Ledger Technology. Smart contracts are blockchain-deployed programs that perform a predefined set of actions when predetermined conditions are satisfied. The contents, that is the clauses of the contract, are encoded as if-then-else rules. As shown in figure, a smart contract consists of contract status information, contents, that is encoding of clauses into if-then-else rules, and detailed rule set. Smart contracts can be triggered by external events or other inputs. These inputs may come manually from information systems or could be automatically received through Internet of Things systems or protocols. Once the inputs satisfy the encoded rules, the contract executes transactions on digital assets or other business logic. The important thing to note is that smart contracts have both on-blockchain and off-blockchain part. The on-blockchain part is akin to rules, status, and clauses, whereas off-blockchain part is mainly related to input and verification whether certain events have taken place or not. Ethereum was one of the first public blockchains that was actually designed to run different kind of smart contracts on a public blockchain network. Once we have understood the smart contracts, the second thing to understand is the concept of private distributed ledger technology. Private distributed ledger technology is a decentralized database which is managed by multiple participants across multiple nodes. One of the most famous private DLT technologies is Corda from R3. What are the main differences between private DLT technologies and blockchain? Number one, unlike public blockchains, the transactions in private DLTs are considered private amongst the involved parties and are only cryptographically linked to the previous transactions that the current transaction depends on. Consequently, transaction histories are only available to parties that participate in the transaction. The second difference is private DLTs do not confirm transactions in batches. They rather confirm transactions in real time. The third difference is private DLTs use versions of a smart contract under which the concerned parties mutually agree, eliminating the need for third parties, as happens on public blockchains in the form of consensus algorithms and consensus rules. In fact, the movement to private DLT technology could be linked to milding the promise of blockchain to suit existing companies and existing laws. In this sense, private DLTs could also link digital version of existing legal contracts with digital signatures. In this manner, we could say that the private DLTs promote themselves to be friendly towards existing regulations and laws. One of the most prominent example of where a smart contract and private DLT technologies could work in tandem is housing sales. One of the most popular projects in Finland is called DIAS project. In DIAS project, by the use of distributed ledger technologies and various players like banks, property inspectors, realtors, even property registration authorities and tax authorities, as well as buyers and sellers, the transaction could be automated. The other most obvious use of a smart contract is in the area of trade finance. And in this, we could see a company in Europe emerging to take the center stage. The company is called VTrade. As we could see here, on the left side of the figure, we can see without blockchain how letter of credit requests and trade takes place. If I sum it up in a simple manner, importers actually ask exporters to send goods. Then both of them enter into a trade contract. To enter into a trade contract, the exporter requires a promise of payment. To do this, importer goes to his own bank, asks for a letter of credit request, and promises payment in future. Importer bank issues letter of credit and sends it to the exporter's bank. Exporters bank send the letter of credit notification to exporters. Then exporters provide shipment of good information to its bank. This document is further passed on to the importer's bank, and when importer has received the goods and has inspected whether those goods are worthy of use or not, they allow their bank to pass on the payment to the exporter bank and from exporter bank to the exporters. All these complicated processes can be easily handled by smart contract and private DLT technologies, where parties have a running node at their center. Again, important thing to note with respect to smart contract and private DLTs is that private DLTs can not only use smart contracts for automation, but can also back them up with real-time digital legal contracts signed by legally valid digital signatures. We have covered different applications of blockchain technologies in general, from public token-based approaches to private distributed ledger technology-based applications. Now let us try to understand how we can think about the deployment of blockchains in our existing businesses, as well as the assembling of a new blockchain-based business venture. To answer the question, we will use the concept of business model canvas developed by Osterwalder. The business model canvas is made up of 9 elements. The first element, key partnership, focuses on how the relationship of a firm with its upstream suppliers work. If we think about implementing private distributed ledger solutions, we find that such implementations can fortify a more trustful digital relationship, strengthen the integrity of the data shared, and enhance the information flow between the suppliers and the focal firm. Furthermore, time for carrying out transactions could be significantly reduced due to digitalization and removal of bureaucratic procedures. Similarly, the exchange of value, such as payments, could be facilitated by distributed ledger technologies. In terms of services, again, similar benefits accrue to companies if such services are developed on public blockchain implementations. The second element of key activities focuses on what activities the focal firm implementing blockchain or digital ledger technology should focus on. The most important key activities in this regard would be to implement peer-to-peer networking securely and desirably. In the case of distributed ledger technologies, the privacy of data, where data is accessible to parties involved in transactions, should be ensured. Furthermore, the implementation of blockchain or distributed ledger technologies will also require re-engineering and reconfiguration of the business processes inside the firm to suit the new technological requirements. The third element of key resources focuses on what vital resources the focal firm implementing blockchain or digital ledger technology should focus on. Obviously, companies should train their employees to use new peer-to-peer networks safely. In addition, documentation, verification of received messages, and new auditing approaches would need investment. The fourth element of value proposition focuses on the unique proposition the focal firm implementing blockchain or digital ledger technologies offer to downstream partners or customers. Again, using blockchain or distributed ledger technologies, the focal firms offer reduced fees and time of transaction. The focal firm can also cut intermediaries and reach directly to customers. Think about the evolution of e-commerce technology, where Amazon and Dell started directly delivering to their customers and thereby reduced the need for retail stores. Such business models could be easily facilitated by blockchain-based technologies, where customers can pay directly to businesses without the use of intermediaries such as banks or credit cards. Furthermore, blockchain and distributed ledger technologies could also enable new product and service to be launched. For example, digital identities and tokenized assets could be easily offered using such technologies. The fifth element of customer relationship focuses on how the focal firm implementing blockchain or digital ledger technology can manage their customer relationships. Again, blockchain technology facilitates the deployment of automated, transparent, direct relationships and self-services, as have been already highlighted. The sixth element of channels focuses on what delivery channels the focal firm implementing blockchain or digital ledger technologies can provide to their customers. Like e-commerce channels, blockchain technologies can offer new blockchain-enabled channels due to its peer-to-peer based system. Again, to access these services seamlessly, clients would need to install new applications and softwares, such as digital clients in case of public blockchain and full functioning nodes in case of private distributed ledger technologies. The seventh element of the customer segment allows us to understand the type of customer or customer groups blockchain and distributed ledger technologies will enable a firm to access. Blockchain technology can provide access to global customers. However, firms need to be cautious here, since governments would put regulations restricting free trade that allows companies to manipulate their taxation. As and when the adoption of blockchain becomes more popular among the new generations, companies would be able to market their products to this specific segment. Think about digital banking. It is more popular among younger people compared to older generations. The eighth element of cost structure allows us to understand cost savings or changes in cost structure due to the implementation of blockchain or distributed ledger technologies in a firm. Here, we could see that the search, negotiation, and transaction costs between suppliers and the focal firm implementing blockchain would fall. However, the cost of deploying IT and training employees will rise in the beginning, since investment would need to be made to develop blockchain compatible software solutions as well as training employees to use the new systems. In terms of the final element of revenue streams, it could be argued that blockchain technologies will allow disintermediation and thus will allow companies to directly access customers. The direct access to customers would enhance the revenue of the firms, as they will get rid of intermediaries and the commissions charged by such intermediaries. With less intermediation, benefits would accrue to customers in terms of lesser price as well. Furthermore, blockchain technology-enabled payment would also push the commissions down for Visa and MasterCard networks that currently charge from retailers that are actually passed down to the customers through prices.